Hey guys, welcome back to the channel, and this week we got another special topic, and it's going to be on crypto mining and blockchain. So this is not something we covered in the last crypto video, but I hope you can learn something, apply it to your investing, and I'll see you all next week. Welcome everyone. This week's topic is a continuation of our cryptocurrency lecture from a few weeks ago. And we're going to be taking a look at cryptocurrency mining and specifically at Bitcoin mining. And this is in relation to blockchain. So although it's often spoken about online and on forums that you may have seen, it may seem easy and profitable. But as I'm sure you know, there is much more than meets the eye. Crypto mining in general is the process with which individuals or companies with highly specialized computers solve complex algorithmic problems in order to verify transactions, add security to the whole system, and to issue new coins. And all of this together adds value to the whole cryptocurrency market. Many miners work together to form a miner network that shares a common transactional record. And this is called a blockchain. And we'll talk more about this down below. So the whole idea of cryptocurrency is to be decentralized, which is unlike the traditional banking system, which includes central banks and governments. The main difference between how transactions are recorded and processed. In the traditional banking system, which includes central banks and government, we see that a ledger is essentially a record of all transactions that are authorized by banks and approved and verified by the central bank. And only a number of chartered banks, which are the big banks, are able to access this ledger. So in a decentralized system, like Bitcoin, this ledger is visible for everyone to access. And in this environment, it has a special name. And again, this is blockchain. So the question is, how do Bitcoin transactions get verified? Well, this is actually the beauty of the cryptocurrency market, because everyone who wants to mine can help make Bitcoin better by providing verification of transactions and add to its security. Essentially, mining computers solve cryptographic algorithms called hashes. These hashes, when solved, ensures that transactions are verified and they are added to the blockchain. And they'll actually look for a solution to them. The miner then receives compensation in terms of payment in cryptocurrency. And the transaction is added to what's called a block. So to fully understand mining a little bit better, let's take a look at how a blockchain operates. So to start, we need to know some terms. A node is the devices of all miners that exist inside the blockchain. A transaction, on the other hand, starts the process of mining and verification. So this means that we need people who buy and sell Bitcoin constantly, or any other cryptocurrency for that matter. Hashes are algorithmic functions used to verify transactions, along with some information from the previous block, which includes the header, and something called a nonce, which is a random number that miners are solving for. A block, as we've talked about before, is a list of transactions that have taken place and are started anew every 10 minutes, more or less, and this is an average. And once they're completed, it's virtually impossible to change transactions within the block. Once published, the only way to reverse transactions is by having more than 51% of the network hash power, but with millions of miners, this means immense resources to do so, which is not profitable. The blockchain is then the chronological list of posted transactions as a chain of blocks, hence its name, and provides an easy way for everyone in the crypto space to review transactions, and it adds transparency for everyone involved. Once a transaction has taken place, a header is used from the old block as well as a nonce, which miners then need to verify. Once they've done this, the block is said to be confirmed. Now, the number of confirmations in order to deem a transaction safe depends on the sum of the money in question. Generally speaking, anything over $10,000 requires 6 confirmations, and in this case 6 blocks are needed to be verified, which take about 10 minutes each. So to be published it could take about an hour, and smaller sums of money can take as little as 10 minutes. So if less than 10 minutes has gone by, this means it's still reversible, and this is really dangerous. That means that if less than 10 minutes has gone by, we do not send goods to the other party. This is really dangerous. And mining may seem really attractive, but there are definitely some reasons that it's not for everyone. These include things like your location, which may not allow crypto mining in your country. The compensation is much less than it was when mining first started. Every 4 years, the compensation for mining is halved, it's called. In 2009, 50 Bitcoin was paid per block published, but then since then has undergone 3 halvings, and now we're at 6.25 Bitcoin per block until 2024. Third, it is very intense in terms of its use of resources. We need good GPUs and CPUs. And finally, it's very expensive. The cost of electricity and your computers play a big role in profitability. In terms of what you need to be successful in terms of hardware and software to become a successful crypto miner, you need these things. You need a Bitcoin wallet to which your earned Bitcoins go, an exchange in order to buy and sell more if needed, such as Coinbase or Square, mining hardware such as an ASIC miner, which are practically needed these days to mine. We also need a mining pool software, and a mining pool actually allows you to earn partially from net effort of hash rate of many miners, since it's unlikely you'll be able to solve a block yourself with your hash rate. So if you contribute 1% of your hash rate to the pool, you can essentially earn 1% of the total payoff for the block, or 6.25 Bitcoin. So this is much more efficient. We also need mining software, which hooks into the mining pool. And finally, you need to ensure that your electricity costs are very low in order to accommodate. Mining has become very competitive due to things called mining farms. These organizations are situated in locations with very cheap electricity and usually in temperature-controlled warehouses. They easily mine blocks and can make easily over $100,000 per day in Bitcoin equivalent, more than any individual miner can do, which makes it really competitive. Although many argue the electricity used in mining processes is wasteful, it is attempting to create a new banking system. So if you think of traditional finance, the amount of energy used for the banking system and finance, it is not even comparable. So given clean energy advances, cryptocurrency could very well be the future of currency as we know it. I'll see you guys next time.